In this module, we will turn our attention to the topic of contingent liabilities and the question of when should we report a debt when it's not an absolute certainty that will occur in the future. So to understand contingent liabilities, we first have to understand the concept of a liability in general. What I have here is the GAAP definition of a liability, and it states that it's a probable future sacrifice of economic benefits rising from present obligations of a company to transfer assets or provide services in the future to other entities as a result of past transactions or events. So that is a long statement, and we have several different things going on here. First of all, I have highlighted the word probable. We're going to use this later on in this module, but we have to be aware that in order to report something as a liability, it doesn't have to be a guarantee. It doesn't have to be absolutely certain. It has to be probable. Probable means it's a higher likelihood, more likely than not. We won't get to actually when something becomes probable versus just reasonably likely, but we're just going to stick that term out there. Probable, it's a future sacrifice of economic benefits. In other words, at some point in the future, we're going to have to give something up. Now, the reason it's in the future is that if it was taken care of this year, this period, it would no longer be a liability. We would have liquidated or extinguished that liability. We would have essentially paid it off, and we would no longer be reporting it. That's why we're saying it's a future sacrifice. The fact that it's a liability today means that we know at some point in the future we will have to owe something. Now this arises, and by the way, the sacrifice of economic benefits, this in many cases is giving up cash, arising from present obligations of a company, so we know on this day that we know this obligation exists, and the obligation is either to transfer assets, which again could simply be paying cash, could be giving them some other asset, or it could be providing services in the future. This comes up when somebody prepays for services. On the day that we receive the payment, we have a liability. We have unearned revenue because we have not provided the services yet. In the future, when we do provide the services, then we will take care of the liability. And of course, this is to other entities. And the key thing here is this is a result of past transactions or events. Something has happened in the past that has caused us to have this liability. So this is the definition of a liability, but what I want to focus in on, again, is that word probable. So the questions we have here, we want to know when do we need to record a liability versus simply talking about it and disclosing it in the footnotes. As I mentioned earlier, probable does not necessarily mean that it's definite. Of course, if it's a known liability, if it's definite that we owe it, like a bond or a loan that we took out, there's no question we definitely do owe that. But we could have other situations where it's just probable. So again, it's based on a past event, otherwise it's not a liability, but it's also dependent upon something happening in the future. We won't know for sure how much we owe, whether we really did owe it, until something happens in the future. But we're not going to wait until that future event to record anything. We want to record the liability here if we think we will eventually owe something. So we have to ask ourselves a couple of questions. How likely is it to occur? We're going to see some options in a bit. And do we know the amount? To record something, we have to know the amount to record. Some classic examples that come up with contingent liabilities. Let's start with lawsuits. Something has happened in the past and now we're being sued for it. So it meets most of the definition of the liability, but at this point in time we don't know for sure whether we're going to lose it and have to pay the liability or the lawsuit off. So it's contingent upon the case being settled or the decision being rendered. It's a lawsuit. A guarantee, this is, when we use the term guarantee, a lot of times this is when we have essentially co-signed for either another individual or another company that we're perhaps related to. We've co-signed on their debt, and this would be a situation where if they do not pay in the future, we then become responsible for the debt. So again, how likely is it that the other party is going to not pay? Environmental issues, a lot of times this will come up. It's similar to a lawsuit, maybe a penalty or fine. Something has happened in the past, and now we have an issue now. We don't know perhaps what the amount is going to be. You can think of the BP oil spill here. When it was occurring, that lasted for quite some time, and nobody really knew what the final impact was going to be. And for that matter, there's still things that are being impacted by that oil spill as well. So at that point in time, it was contingent. Yes, we knew we were going to owe something, but it was hard to estimate the actual amount. And then product warranties. So in another module, we've talked about warranties. The fact that we have provided a warranty for our product makes it likely that somebody is going to have a claim against that warranty in the future. So the question is, can we reasonably estimate it or not? And if you've listened to our warranty module, you know how we talked about the reporting of that, the estimation of the warranties, and how to record that liability. That's just another example of a contingent liability. So what we have in summary, this really defines how we need to handle these liabilities. We have to take a look at whether or not it was estimable or not. In other words, could it be estimated? And how likely was it to happen? It could be probable, which meets the definition of a liability. If it's just reasonably possible, it's not defined as a liability. And then, of course, if it's remote. In other words, we've done our analysis, and we just really don't think there's much of a chance at all of this happening. Somebody has sued us, but we really don't think they have a case. In our own honest opinion from our legal team, we just do not think there's a case. In the case of a remote likelihood, we don't have to do anything. We've talked about it internally. We do not have to put it on the footnotes. We certainly don't have to record a liability, so no need to do anything. If it's reasonably possible, it does not rise to the level of reporting a liability. It has to be probable to be an actual liability. Now, what we would do in this situation, though, is we would want to disclose it in the footnotes, disclose the issue and the fact that, hey, there's a fair chance of this happening, but we don't believe it's high enough to consider it probable. Therefore, we are not recording a liability on the balance sheet. But again, the footnote is required there. Now, if it's probable and estimable, then we have to record an actual liability. And of course, we would want to include it in the footnotes as well to give a little more explanation for it. But the key thing there is we would be recording the liability. If it's probable and we cannot estimate it, if you can't estimate it, there's no way to possibly record it in the balance sheet as a liability. You have to have an amount to put there. So the best we can do here is just record it as a footnote. Still better than nothing. So when you're dealing with contingent liabilities, this chart right here is important to understand for when to record the liability and when just to disclose it as a footnote and when you do not need to do anything.